Welcome to the daily update, where I'll go over the action in the market for Monday, May 12th, and we'll see how things look for Tuesday, May 13th. Okay, it was an everything up day. The trade talks over the weekend were well accepted, and the little bit of a drawback is that it's only good for 90 days, but at least the market had a positive reaction to what has developed to this point. There's also apparently a ceasefire between India and Pakistan. Doesn't have a real direct impact on U.S. stocks anyway, but if it escalates, it could. And so if they're talking and not trying to kill each other all the time, that's a good thing all the way around. So, but the market liked what happened over the weekend, and a lot of things happened over the weekend. It's been very busy these days, and that's one of the real challenges that we have right now, where I do everything based on charts, but I do pay attention to the fundamentals, which one of the areas of fundamentals is the news. And we were kind of just bouncing along. Last week was not a real week full of conviction. And that was being borne out by some of our charts, even though we've been looking more positive. Well, that's changed now. When I started recording this about 8 hours before the market opens, the futures are down about a third of a percent. We'll see. Are we going to get any follow through to this? Because a lot of damage that had been done throughout April is now being repaired. In the short term, we are looking extreme as far as some of our indicators, and a pullback or a decline would not necessarily be a surprise. But we're now positive in the short, intermediate, and long term. Now, we're still in a downtrend in the long term, but we're above the 200-day moving average. And so I do that as a two-step process. Where is price in relation to the 200-day moving average? We're above that now. That's positive. But when the 50-period moving average is below the 200-day moving average, which it is, that's still negative. So we're not in a bear market, but we are in a downtrend. Okay, one thing to point out is that, first of all, not related to what you see right here, but I'm going to be changing some things on the YouTube and Rumble channels as far as what is posted, and I'm introducing some new things. I might be taking some other things out. If you have any feedback on that, please feel free to leave a comment, because I do a video every day. I do a weekly video, and those are available as a membership now, where you can have access to those right when they're available, where I delay posting them on the YouTube and Rumble channels to make them public. If you find them useful after they become public, even though it's somewhat outdated, I think they're outdated, feel free. Um, if you want them to be available right when they're made available, then there'll be a YouTube membership site that I'm launching pretty soon here. Now, what about the intermarket analysis video? Some of you watch that. I've noticed that I can do that video. It's a weekly video now. I do it week after week after week, but we might go a month or two and not really see any changes in the overall picture of how I look at things that way. Do you find yourself relying on the intermarket analysis video? I'm thinking of maybe changing that to a monthly type video, or I look at the charts every day and then maybe do an update when it's needed, and if something substantial seems to be changing. What about the deep dive video? Some of you really rely on that video. You like that video. I'm thinking, okay, maybe I'll just put that into the membership program for people that are in the full program that I have, and just have access to it there. What about the what to watch video? There are some times when a lot of people really like that video. Other times it just kind of sits there and people don't really pay attention to it. The problem that I'm running into is that with the YouTube algorithm, and even Rumble to a degree, is that I post so much stuff, it kind of gets lost. And I want to help people. I want to educate people and try to give you insights that maybe you're not getting other ways. But that's not helping if the videos aren't discoverable if they're not being put up there for you to watch. So if you have any feedback on this, I would love to hear it. Probably an email would be better. That's more private. You can leave a comment, and if it's a legitimate comment, I will certainly respond to that. Now, the other thing that I want to bring up is I have to take a trip, and I won't be able to prepare a daily video for Wednesday. I'm going to be traveling during that time. So this is the video for Tuesday. I will anticipate, if the trip goes okay, that I'll do another video for Thursday. Okay, let's go back and talk about what happened. Right at the open, we had a huge gap higher open. The futures were up anywhere from about 2.5 to 3% Sunday evening, and they held on to that and then saw even more of an upthrust as we approached the open on Monday. So we ended up gapping with a huge gap higher at R4 at 58.08. So we're above the 5,800 level again. And then the market really wasn't sure what to do after that. We chopped above and below R4, but then we were able to break out above this sideways price movement that we saw. We got further above R4. We closed a little bit below 58.50 at the intraday high for the day. Some of that was probably short covering later on. It's like, okay, we're not coming back. I need to get out. And when people directly short the market, they sell to get in and they have to buy to get out. And that means you have a whole lot of buying going into the close, and they're losing. They have to close out. It's not like when you buy a stock and you buy it at 10 and it goes to 3, well, I'll just hang on to it and see what happens. If you didn't buy it on margin, if you paid with cash, you can hold out indefinitely, hoping that it'll eventually come back. All right, but anyway, short covers or short people that participate in short selling don't have that ability to wait. So we ended up being up 3.26%, and we were back above average with volume. So not a huge spike in volume, but we've been seeing below average volume for the most part. So there was some participation here. Now we're positive again in the short, intermediate, and long term when you measure it of where are we in relation to the various moving averages. Interest rates did go up. Now we're watching that because we're getting closer to that 4.5% level with the 10-year yield, which that can spook the markets at some point. The dollar had a good day too, really going up. It's still in a downtrend, but it bounced. And everything was all about the trade deal. And that's really what's driving things right now. You've got people starting to change their forecasts. It's like, oh, maybe things are going to turn out okay. After all, we're going to raise our S&P forecast. We're going to lower our forecast for going into a recession. We'll see. That, Monday was a day. We'll see what the rest of the week can bring and how people are going to relate to that. And it's all about the tariffs for right now. Okay, so some comments. It was a day of broad-based gains. And it was an everything rally. Value went up, growth went up, growth did outperform, and there was short covering. And then you have this thing called FOMO, the fear of missing out. People are like, oh my gosh, I got to get into the market. I'm going to miss out on this great opportunity. A lot of the bounce that we've seen lately has been attributed to that. I don't necessarily know if I agree with that. You have the people that tend to react to what happens, and those are the fear of missing out folks. And instead of seeing the charts and seeing things set up, and when things are a little calmer and quieter, when it's all pop news and the market's going down, that doesn't last for very long, and people are emotionally reacting to that. Well, the fear of missing out is an emotional reaction, which sometimes means, okay, it looks like the party might be about over, because they just do things based on some instinct or gut feeling, which you're going to be right just enough to justify that that's legitimate, but you're going to be wrong a lot. And when you're wrong, you're going to be really wrong about that. All right, so there was a lot of enthusiasm over the easing in the trade war with China. Both the U.S. and China agreed to a 90-day reduction. It's like, okay, if we could ink these out and make them permanent, that would make us feel a little bit better. But at least 90 days. Okay, that's a start. Maybe it'll give the U.S. and China more time to talk and actually hammer out these deals. And it'll be effective Wednesday. So still have another day to go for that. with the U.S. dropping tariffs on China from 145% down to 30, and China, who's having a lot of economic problems right now, it's not like their economy is firing on all cylinders. And this they depend on trade with the US. So it's to their benefit to come to the table and make a deal. Where the tariffs had been 125%, they've lowered them to 10. All right. So there's still tariffs there, but a lot less than what they were. The good news for the market is that the reductions were larger than expected. That's what the market was reacting to. The thing that's making it a little bit, okay, let's see here. It's going to expire in 90 days if a more permanent trade deal can't be reached, but at least it buys some time. Mega caps and growth did have a good day. Now we're still plowing our way back, and I have some new charts that I'll show here in just a moment to kind of talk about what's been happening with the overall dynamics. And we're back under 20 with the VIX. That's good. We've been above 20 for quite some time. We're at 18.39 currently, and that means fear is coming out of the market. And when we're above 20, that's when we see negative annualized returns. When we're below 20, that's when we see positive annualized returns. And pretty long list here, the usual charts, the Stoch RSI, Williams percent R, CCI 1420, and Stochastics. Those are the ones that just show we're having good positive momentum. But we're getting kind of extreme with the 20-period exponential moving average on the S&P. And then the rate of change going back 5, 10, and 20 days. That's looking extreme. And I'll show you charts of all these things. We're even further away from the 20-period moving average. We were already extended. Now we're even way more extended with the boom indicator. The slope oscillator, which we've been keeping an eye on, it's giving us an extreme reading. And then the short-term RSI based on 9 periods. Also starting to develop a little longer list here in the intermediate term. The CMB composite, standard deviation, those are new additions to the list. Now, over the weekend, I pointed out that the TTM squeeze, it's extreme positive, but it was turning color to mean it's more negative. Now it's switching back to the lighter color to mean more positive. We're looking a bit extreme here with the McClellan oscillator for the S&P. The PMO studies, that's been on the list for a while. And the bullish percent indexes, I like these indicators because they're different. They're not moving averages. They're not momentum based. They're not oscillators that we use. It's a completely different way of measuring strength inside of an index in this case. The S&P and NASDAQ 100 bullish percent indexes are extreme. We're also now getting far away from the 50-period moving average. That's what the boom indicator measures. And we're starting to get extreme with our advanced decline oscillator that looks over the last 10 periods. Then no change to the overall scenario. The Fed just came out last week and said, well, we need more information. So they really didn't change anything there. The dollar was up and up pretty strong, but not enough to really change it over to a positive trend based on how I look at things. Interest rates were up 4.46%, where we had been at 4.38%. Were they rising in anticipation that this will stimulate economic growth? And they're afraid that the growth is going to kick back into gear? That would be the opposite of a recession. So it could end up being positive, but too much of a good thing can start to spook out the markets. We're watching that 4.5% level there. Sentiment is still positive. We're at 66, where after Friday we were at 62. We're not inverted right now with the 10-year to the 3-month. Now, most people follow the 10-year to the 2-year, and that's kind of the standard one. I also follow the 10-year to the 3-month. It's no longer inverted. We'll be keeping an eye on that one. And we're still not trending. It would have been nice if this over 3% gain could have happened maybe over 2 or 3 days. It would have helped some of our indicators not be extreme and actually shift, because things like the ADX, which I used to look at the condition of the trend, one move in one day doesn't have as much of an impact as maybe 2 or 3 days of the same kind of move. So we're still not trending there, and we're below the moving average, and we're below 20. That's why we're not trending. But with the update, the bias is positive and the momentum is positive. And ever since we hit those lows in early April, it's been almost impossible. If you want to look at a chart and go back and say, oh, I should have got in here, the bottom was in, nobody knew that at the time. Things could have just fallen apart as easily as they're coming together, and things were looking pretty negative. And hindsight in the stock market is more than 2020, but you have to go under what's happening right now and to second guess, well, I should have done this, I should have done that. Well, what if the news hadn't been good? What if there was no ceasefire between Pakistan and India and things are escalating and the U.S. is going to be getting involved? Things could have gone bad just as easily. So that's why I look at charts because of it's all of the known information that we have. And we were getting mixed pictures. Some things were looking positive, some things were looking more negative. All right, we just had the Treasury budget, which actually came out with a surplus, probably because it's for April and people had to pay their taxes. And a year ago, it was also positive, but most of the year, they usually run a deficit here. So here is the chart just showing it's negative overall. This is the trailing 12 months federal budget, and it's always that way. You know, this whole balanced budget, that means we would be at zero or actually positive here. But it's less negative than what we saw before. And then a lot of this has to do with the receipts. Actually, that went down just a little bit. And then outlays are really going up here. And this could be some front running ahead of all these tariff things that are going on. So here is a look at some Isabel Net blog charts here. These are the announced and actual buybacks. So the blue line is, yeah, we're going to buy some of our own stock. And then the green line, these are the folks that actually followed through with that and actually did it. So just because the company announces that they're going to do a buyback doesn't mean it's actually going to happen. All right, and then the PE ratios, and I usually go over this in the intermarket analysis video here. We focus mostly on the S&P, which even after Friday was at 21, and we're above 20. We use that 10, 15, 20 scale, and when we get above 20, that's considered to be expensive, and that's the S&P as a whole. Now, if you just take the equal weight, where all the stocks are treated the same, it's above 15, but it's below 20, coming in at 17. So it's more fairly priced, where the mid caps over here are fairly priced. I don't agree with this one. I don't know where they're coming up with this number. The small cap index that I look at over the weekend, it has it down about where the mid caps are, more fairly priced. But the Russell 2000, it's coming in at 23. I can understand the NASDAQ 100. That's growth, and people are willing to pay more for that. That has more of a premium attached to it. All right, then the sell-off in U.S. equities through the first week of April occurred largely during overnight trading hours. The gap lowers that we saw, but the rally that we saw actually saw prices come back during trading hours. That's seen as more positive, while the returns during overnight have then been muted. And this kind of compares them. Here, the blue line, this is, we've been seeing buying coming back, and this is the overnight trading where we see a lot of the gap down here. And gold tumbles after U.S. China trade breakthrough. It's coming down. It was going up in a response to insanity and uncertainty. And now that something a little more substantial has at least been announced and hopefully will lead to something more concrete, that's kind of taking a bit of the luster out of gold. But gold is, I don't look at a lot of charts of gold, but it's likely overbought and it was becoming the thing to do. And that's when usually it's run its course at that point. And then stock rally hits a wall ahead of US. This was last week. And this is like, oh, 56.59, 56.50. That's where we closed on Friday. We're up in the 58 range now. So that was so last week. And then the 90-day pause announcement that there was no intention of firing the Fed chair. There's been news about the trade talks. It drove the S&P higher over the previous 3 weeks, but it went sideways last week because there was a lot of apprehension about these trade talks between the U.S. and China. And I pointed that out in the daily video for Monday and the weekly videos and so forth. And the earnings per share revision tracking, it's near its historical pattern. Some of this is only makes sense because when an analyst puts out a projection, they're going to be much rosier off into the future. Well, as it gets closer and closer, they're going to refine that, and they usually have to revise it down. And we are seeing that. and the earnings are still positive, and we just kind of came through the bulk of earnings season with a lot of the companies looking pretty good with healthy profits and even revenues, but they're not as the forecasts aren't as great as they were before. All right, then these are a series of charts, and I sometimes don't use any of these charts. Sometimes I use quite a bit of a number of them. I have a lot of them today. This is called SLOOS. You gotta love that. Bank loan officers reported tighter lending standards and weaker demand for commercial and industrial loans across in the first quarter. Okay, so they're seeing less of a demand there, but a greater demand here with domestic tightening standards actually going up. Then the dollar net short positioning dropped to minus 17 billion this week from 16.6 last week. This is where the dollar bottomed in 2023, 2024. And that's been one of the kind of mysteries of going on. As gold has been going up, the dollar's been going down. And when a country does something that's considered to be more protectionist, where the U.S. is doing things that are more in the U.S. best interest, that's the attempt that's going on here. A currency should go up. Well, we've been seeing the opposite of that. Well, maybe now that things are a little bit more defined and there's actually some substance there, that might help the dollar to rebound a little bit more because it has really been taking a hit. All right, and then single stock skew. Now, this is a little bit different than the skew index that I refer to sometimes. There's still room for relief rallies in U.S. equities, single stock put call skew, which is it's kind of like what I look at. Um, has been a great crowdsourced metric to describe fear levels over the past 20 years. That's one of the reasons I show a variation of this. We believe this shows that the rally is not crowded, too many people in it right now, but this is before Monday. So and there's more room for fear levels to decline. Yeah, we're just now coming down below 20 with the VIX. This remains the most useful quantitative option signal for predicting forward returns. Okay, this is just things are looking a little better here. Okay, then the Nasdaq 100, when it gets back above its 200-day moving average, which it did on Monday, these are the returns looking out. 1 week later, not so much, up, down about half the time. 2 weeks later, all the way out to 1 year later. And the further out you go, the better the returns end up being. Then earnings sentiment, it's finally improving, where the dark blue line here is really going back up. And this is sentiment. These aren't actual earnings. These are just how are people feeling about earnings. And that's seeing a real improvement when you compare it to the rest of the world. All right, here is the intraday chart. Excuse me here. You got to love these take one videos. We finally got, you think, just a little bit above that 5,700 psychological level, which had been acting as resistance. We tried to come up to it on Thursday. We hit the 200-day moving average for the SPY, came back down, never got back above it on Friday. Well, left it in the rearview mirror on Monday, where we got all the way up to R4. I go to pivotpointcalculator.com because the software only calculates R1 and R2. I have to calculate R3 and R4 myself. It doesn't have an R5. So we might have got up here to R5, but I'm not quite sure if we're, but it was good anyway. But this is where most of the gain came from, and we just chopped for a while. Well, then finally, later on, about lunchtime, about when the smart money starts coming in and deciding what they want to do, they started doing some buying, not real strong, and we kind of leveled off. This probably was a lot of short covering because to meet their margin requirements, people that are short the market, they've got to get out by the close, and they're taking a big hit right now, and so they have to buy, and that can really push prices up right near at the end of the day. Then here is the chart drifting a little bit in the initial overnight session, but this is where we closed on Friday. And then Sunday evening, boom, just went up and even built on those gains, but we gave some of it back right after the market opened, but then we saw some strength later in the day. A very healthy day, what the market kind of needed right now. We're still seeing the blue line above the red line intraday, meaning growth is outperforming value. The growth to value ratio in intraday for the S&P looking good, showing real improvement here. And then our end of day charts where growth, everything was up, but growth was up more than value for the large caps and for the mid caps, and actually up less for the small caps. But there was one point where the small cap index was up over 4%. It gave some of that back, but it was still up more with value. And actually came down a little bit on a closing basis. But this is hanging on to an uptrend with small cap growth to value. Mid cap growth to value improving. Where we saw more of an improvement is the S&P growth to value end of day chart. But we're still in a downtrend here. But the longer we can stay above these lines, the more we might see the blue line coming back up and crossing above the red line. But that's going to take some time. And we're actually breaking out of the rainbow here with the growth to value ratio with these ETFs. We kind of were camped out in the middle of the rainbow. Maybe things can start to show some improvement here. And discretionary to staples in a downtrend with the overall ratio, but did improve. Where staples have been going sideways. We actually saw discretionary breaking out a little bit here. And then this breaks it down a little bit different. The chart that I just showed you, that's the second chart. Discretionary to staples equal weight, where it was declining and getting more defensive. Now it's possibly beginning to turn more offensive, which would be positive. Now, the top chart, that's the weighted version of the discretionary to staples ratio, and that's improving. Then we look at tech, which is growth compared to utilities, which is usually considered to be value. But as I always say, you could make a case that utilities are growth because of all the need for electricity these days. This has been more defensive, now improving. Biotech, which is the growth area, versus healthcare, which is defensive, improving. And then hotels, discretionary. You don't have to stay in a hotel. You can sleep in your car, you can go camping, whatever. This is improving when compared to utilities as well, something that you have to have. And then here's some bellwether areas. We are improving with semiconductors, but a long ways to go. Home builders improving, a long ways to go. Transports improving, a long ways to go. Retail, it's been doing okay. And the regional banks, see everything gapped up here. It was really quite positive. Then here's some newer stocks. These are momentum stocks. They're stocks where they're just looking like they have solid momentum, and there's an ETF that goes with that. And then I do a ratio of the momentum stocks, and that can change because there are stocks that come in and out of being in positive momentum. And then a ratio with the SPY. And the thing that I noticed, first of all, was that when we were coming down, we set a low in March. And then when everything was falling apart, we set a higher low here. That meant momentum stocks, this was a positive divergence. And then we've been able to go up from there. Now, it did come down in Monday's session, but overall, the momentum stocks have been outperforming the SPY itself. And then emerging markets, these are markets outside of the US compared to developed markets like Europe, the US. And overall, the developed markets have been underperforming. And I mention that from time to time. This is a chart that just kind of brings that out. But we did see a nice little pop up on Monday. We'll see, is this going to change the overall trend that we've been seeing? And this is not a trend line like over here. This is just connecting it. But this green line here, I'm just doing it to illustrate, to accent what I'm talking about here. It's not a trend line. This is not a trend line either. And the large cap growth improving, getting back above all the moving averages that are plotted here. This green line is the 100 period moving average, and then the red line is the 200. The blue line, which we've been above, is the 50. So that means that we're reclaiming some moving average real estate right here. And this is a newer one too. This is taking value, which is more defensive, and then doing a ratio with tech, which is, of course, growth. This has been coming down. It was really going up when the market was going down as the market was getting more defensive. We've been seeing this ratio actually falling off, and now it really improved in Monday's session as well. And then U.S. and international stocks, and again, this is not a trend line here. And this is what we've been seeing, especially stocks in Europe and some emerging markets. They've been outperforming U.S. stocks. And here's a ratio, which just shows that. Well, maybe it's getting about ready to change, but we need to see more follow through with that. Okay, so here we're just about ready to start a trend in the short term based on the ADX. The green line is above the red line and going up. The red line's going down, but we haven't quite crossed over the moving average yet. And we're below 20. That's why it's considered non-trending. And this is what I was saying. It'd be nice if this move up could have taken 2 or 3 or 4 days. That would have helped the ADX to improve instead of it looking like, okay, this is an outlier and I'm not sure what to do with that. Are we going to come back down and try to fill in this gap here? So we're still not trending and we're below 20 with the ADX, although we are positive. Volume did pick up, but it's been well below average overall. You can see that here. All last week, in the last few weeks, it's been below average. We did go above average in Monday's session. And then the weekly composite sentiment gauge. Now, this is before Monday, so we're still looking more positive here. This is kind of lining up more with what we're seeing with the indexes that I use every day. This is also likely to improve. This is before Monday's session, where folks were still getting more pessimistic about things. And then once a week, I look at the insider buying ETF. That is improving as well. And it follows what the market does, and it had been under pressure as well. And looking at the VIX, for the first time, going back to late March, we went above 20 in March and then only to come back down. But we spent all of April above 20 with the VIX and almost halfway through May above 20. Well, finally, it's starting to drop back down, and that's more positive. When that falls, the VIX of the VIX also is falling. And the momentum of the VIX continues to be down. This fear gauge fell. This other fear gauge really fell here. So we're seeing confirmation there. This I had it in the wrong spot. This is just showing, it actually is a little negative, the insider transaction. These are legal insiders, corporate CEOs and officers of a company. They've been doing a lot of buying as the market was down, which is positive, but is that run about over for now? And the daily equity put call chart down, as you might expect. We're going down with the 5-day chart and kind of going down here with the 10-day chart. We are improving with the risk on to risk off ratio. Going up, that means folks are getting more risk on and preferring stocks. We're also seeing the high beta versus low beta ratio really going up. It was up over 5%. So this is improving. And we're seeing a pickup here with volatility risk premium, but we're still below the band. And our advanced decline line looking good here, breaking out to a new all-time high based on price, getting close here based on volume. That has been improving as well. The short and intermediate term advanced decline ratio are positive. They're both advancing and above zero. This is where we're looking a little extreme. A 10-day average of the advancers minus decliners we had dropped down. We already had become extreme, and that led to some sideways action for a while. Now we're starting to become extreme again. This can still go higher than where it's at. And it doesn't necessarily mean a reversal. It just might mean that we won't go sideways. And a week ago, that's what I was saying. We were getting a really high reading here, and it doesn't mean that we're going to turn and go the other way. It just meant that we ended up having a sideways week for the most part. And we are improving here with the new highs and new lows, more green than red. We're going up with the 5-day. We're starting to go back up with the 10-day. Our smart money indicator number one, above an advancing moving average and going up, might be getting a little far away from the moving average, but it's positive. This is a concern, though. We're still declining with the Chaikin money flow. The histogram, the green bar here, it went up, but it didn't skyrocket up, and the red line is still going down. That's kind of interesting there. But we did turn positive with the Chaikin oscillator. Now, a week ago Friday, this actually was going down, and we had an up day. This was still declining. It's finally picking up something that it likes and is turning more positive now. So if you go back to the first one, this is positive. This is smart money indicator number one, but number two is negative. Number three is just turned back to being positive. Vortex declined a little bit with the green line, but still positive here with the green line above the red line. And I haven't been showing a lot of the advanced decline studies lately because we've just been chopping along here. Well, we're improving. We're actually breaking out with the cumulative advanced decline line for the S&P based on price, setting a new high there. And that's actually more of a positive divergence because we're setting a new high here where we have yet to set another all-time high with the S&P. And we're just close to an all-time high here with the cumulative advanced decline line for the S&P for volume. And improving with our advanced decline line studies above moving averages with all of the indexes. And we look at the NYSE advanced decline line on a cumulative basis, new all-time high, just about ready here, not quite there to an all-time high with this NYSE advanced decline line and this other NYSE advanced decline line. Notice how we had dropped down, actually triggered a death cross here, but then we've been able to come back above this. The longer we can stay above it, the more this might develop into a golden cross. And then looking at the common stock, not at an all-time high yet when we look at this based on price for the NYSE, but we are setting an all-time high here based on volume. And that's pretty positive there. And now the stocks in the S&P above their 20-period moving averages starting to get extreme again. The 50 period, which had been back above 50, that had already been positive. It's looking quite a bit more positive. And then longer term, we're back above 50 with the 100 and 200 period moving average studies. So that's really showing an improvement there. And here's the daily chart where we were finally able to get above the 200-day moving average. Now, the longer we can stay up here, the more the blue line will start to come back up. And we do have some overhead resistance here at about 5,900 with a pivot point, but that's still 150 points away. So we'll have to see if that develops into anything. And we finally spiked up above the moving average with volume. Now, on a one-day basis, yeah, if you go from Friday to Monday, the one-day rate of change, pretty extreme there. Not things that we usually see all that often. Starting to get extreme with the 5-day rate of change. We are extreme with the 10-day and the 20-day. This is a little longer short term here. Just right on the border here with the 20-period exponential moving average for the S&P, improving with the 50 and 200. This has finally been able to cross back above 50 with the 200-day moving average study. And these are our short-term momentum oscillators here. The Stochastic RSI, extreme positive, the CCI, Williams percent R, CCI 14 and 20. They were off the list before. Now they're on the list. And the short-term stochastic, I mean, you can't get more of a higher reading than 99.76. This is on a scale that stops at 100. So, turning back up in the intermediate short term and extreme, but positive in the long short term. Force index didn't quite hit the Keltner band up here at the top, but it was pretty positive there. Really improving here with the short-term moving average as measured by 20 periods. Green line, blue line going up, well above the 20-period simple and exponential moving averages, and we're far away. That's what the boom indicator is measuring here, where price has a tendency to come back. Now, the longer we stay above these lines, the more the lines will go up. So it doesn't mean we have to come all the way back down to here. Eventually, price will have a tendency to revert back to the moving average, like a rubber band. And we're extreme with the standard deviations chart. We hit all the way up into the +3 channel. Intermediate term, balance of power actually came down a little bit there, but it's still positive, and we're looking better with the bow tie. Short term, the green fluorescent moving average, way above that. The lines are going up, and we're starting to see the red line crossing above the blue line. That's a little bit longer term, 20-period and 30-period exponential moving averages. Getting just barely extreme positive with the CMB composite. We're back above the 200-day moving average here. We're 1%, 1.63% above the 200-day moving average. Haven't seen that in a while. And we're positive with the go, no go with the blue bars. And we're positive with the Landry light system. And we're switching back to positive. We're seeing some green coming in here with the proper order. It had been more neutral, more yellowish. Now it's starting to look more positive. TTM squeeze, man, that's a high reading here, but it is positive, and it's the lighter shade of blue. You can see way higher than other readings that we've seen before. Ease of movement declined a little bit here, but still above zero. We're starting to get extreme, but not quite there with the Arun. We're starting to get extreme with the S&P McClellan oscillator. We're above the 60 level. It could still go up more from where it's at. We just pay more attention to it when it gets above this blue line. And we're going up with the summation index based on price and volume. We're not there. We improved with the NYSE McClellan oscillator, but we're not up to this 80 level here, suggesting that we're extreme right now. But we're still going up with the summation index based on price and volume for the NYSE. Swell and trending oscillator, which was actually declining after Friday, it turned back to positive after Monday. Momentum is positive. We're crossing above the midpoint with the PMO. We're advancing based on price and volume. And we're starting to get extreme with the PMOs that are rising, but this is also showing good solid strength. You can see we were getting high readings here as we were fighting our way coming back up. We're right on the border here with the buy signals, and we're improving with the PMOs that are above zero. We're positive with the Elder's Impulse system for the S&P, and we're positive with the parabolic SAR. I don't have the chart here, but the weekly parabolic SAR after Friday switched back to positive. For the first time in quite some time, we are seeing a dot below the weekly bar from last week. And we're getting extreme here with the slope oscillator. This is a short-term oscillator. It was already extreme a week ago, and then it kind of started to fall back. Now it's showing some strength again. The MACD above the midpoint and going up, that short to intermediate term. That's positive. So we're concerned about the slope oscillator, but the other short-term oscillator, the TSI, we're just kind of humming along, looking better here. The MACD, PMO, and PPO, these are intermediate term. They're positive, and we're positive with the long-term oscillators, TRIX and KST. And we're positive here with the Copic curve. And here's a longer term look where we're starting to get extreme here. There's really no boundary that I found that works on a consistent basis. So we'll just watch this one. And starting to turn more positive with the Sean trend meter. We're getting up into the green area. We're above 50 with the money flow and ultimate oscillator. Above the moving average with unbalanced volume, and the moving average is now going up. That's more positive. And we're above 50 with the intermediate term RSI based on 14 periods. We're getting extreme positive with the RSI 9, which is short term. And the condition of the intermediate term trend really improving. We're starting to see the red line crossing above the blue line, and that's better. The red line is a triple exponential moving average, and it moves a lot faster. When we were going down, the red line was below the blue line as we were going down fast. If the red line can go above the blue line here as we're going up, that just shows more internal strength. And we're well above the 50-period moving average. In fact, probably getting a little far away from that. This had been acting as overhead resistance. It's the 100-period exponential moving average. Well, we not only got above that, we got above the 200-day simple moving average, 100-period simple moving average here. So that's reclaimed overhead resistance that we were able to get back. Here are all the moving averages. We're back for the first time in quite a while. We're above all the plotted moving averages here, but we're far away from the 20 and the 50. You can see the boom indicator saying, whoa, getting a little too far away. The leash is a little long. And we've reclaimed all of the anchored moving averages here. These were acting on the way down. We tried to show them as being support. On the way back up, they were acting as resistance. Now we're finally clearing above them. And the bullish percent index spiked up here. Pretty extreme reading, but still positive at the same time. And we're above 50. We're not extreme with the NYSE bullish percent index. And we are like really extreme here with the NASDAQ 100 bullish percent index. Remember back in April how negative this thing was? Well, now it's kind of in the opposite direction, only being positive. Then, just to point this out, we had been having a difficult time getting above the 61.8% retracement level from the April 2024 low to the February 2025 high. We reclaimed that in Monday's session. Now, if we do start going down, will this act as support? And we're getting above the Ichimoku cloud. We were bumping into this red part here. And it's finally starting to turn green over on this side. That's positive. And we have the blue line above the red line and the green line, which gets mixed up in the bar chart. It is positive as well. So this chart is showing a lot of improvement. And we're looking positive with the Heiken Ashi. The Kegi chart is positive. The Renko chart is positive. And the three-line breakage chart is positive. However you say that. And we had a couple of new X's drawn in here with the point and figure chart. A triple top breakout, which was generated on April 25th. We finally broke out of this box that we were in, and we've been just going up pretty ferociously here. All right, long term, really improving with the 150 and 200 period moving averages. They're crossing back above the midpoint. That's more positive. And we're positive in the short term. We're positive with the S&P and NASDAQ 100. And that's growth. The NASDAQ 100, that's all growth. This is growth and value for the S&P. And also turning positive in the long term again because we reclaimed the 200-day moving averages. Still have a lot of damage to repair with the mid caps and small caps. And then stocks are positive across the board. Bonds are negative based on price. Commodities switched over positive in the short term, as has the dollar, how they measure it. And this is interesting. Utilities ended up being the down sector. But look at discretionary, tech, communication. Now, they were all up strong. We'd like communication to do a little bit better, but it's been holding up better. If you look at the intermarket analysis video where I do ratios of how is communication performing with the S&P, it's been holding up better. But this is good, though, if you're positive on the market. Discretionary, tech, communication. Those are the big three growth areas. Financials were doing good, but then staples were up, but not very much. Real estate, another considered to be defensive area, up, but not very much there. So this was a pro-growth day, but everything benefited except utilities. All right, then here are all the triggers, and I had to like take a bigger screenshot here because a lot of things happened. We had a BPI cross above the financial sector above 80. That's good. Oil got back above 60. Not sure that's so good because then gas prices go up. And then the NASDAQ actually crossed below 17.9, but not for long. It got above 18, 18, 1, 2, 3, 4, 5. Usually these, oh, this is right at the open. And so we're having a hard time figuring out where we're at here. We finally got above 18.7 near the close. And we had a BPI cross above 50 with the NASDAQ. The one that I showed is the NASDAQ 100. Gold is dropping down here. That was one of the last ones. And the S&P got above 5,800. We had discretionary. We like this. It went above 70, then it went above 80. Energy, all right, went above 50, and industrials are above 80. So that pretty positive day there. And we're back above the 200-day moving average. We've been acting as resistance here with the 50-day moving average with the Dow, and this closed above it. That's a good thing. And we're positive with the diamonds, with the Elder's Impulse system. We're back above the 200-day moving average with the NASDAQ. We're still in a downtrend here, but we were above the 50 and below the 200. Now we're above the 200 and we're above this R1 level. And we're positive with the Elder's Impulse system for the NASDAQ. This, we've been really having a difficult time with the 50-day move, 200-day moving average for the NASDAQ 100. We blew that out in the dust, okay? And we're above R1 now. That's really good. That is a positive sign. The cues for the Elder's Impulse system are positive, and the momentum for the NASDAQ 100 is positive. Small caps even hit some resistance here at R1. Finally, we were able to convincingly stay above the 50-day moving average. Improving here. Momentum is positive with the Russell 2000 small caps, but we're starting to get extreme with the RSI. We're still below the 200-day moving average. This is why they're negative in the long term. We need to reclaim that for them to turn positive. And we're positive with the Elder's Impulse system for the small caps. Still coming up with the mid caps underneath the 200-day moving average. If we can get back above that, that would turn that positive long term. Mid caps are positive with the Elder's Impulse system. The Wilshire able to get back above its 200-day moving average. A broad market measure. We also got back above the 200-day moving average with the total U.S. stock ETF. Financial sector up over 2%. That's good. The FANG index still in a downtrend, but just screaming up 4.41%. Apple was up 6.3%. It's, from what I understand, they were the ones kind of getting hurt the most by these tariffs because they do so much business in China. I teach English to Chinese children online. If you ask them what's a smartphone, they have no idea. But if you say iPhone, oh, they all know that. Well, that's Apple. And they all use iPads. And even if you have a Kindle, they call it an iPad anyway. So we're coming back up here, but we're in a downtrend with Apple, but hitting its 50-day moving average. And we're back above the 200-day moving average with Amazon, up 8%. And they are benefiting too from this deal. Microsoft has been doing good since they reported earnings. Meta just generating a death cross here, but up 7.92%. They don't even do business in China. It's blocked in China. Google, another company that's blocked in China. They're coming back up to their 50-day moving average, but still in a downtrend. NVIDIA, still below its 200-day moving average, up 5.44%. Tesla, they do a lot of business in China. They're back above their 200-day moving average. Is that right? Yeah. Netflix, This was the shiner. This kept setting just all-time high after all-time high while everything else was floundering around. It was down 2.65%. Little profit taken there. And we are improving. We're getting back up to the 200-day moving average with the Dow Jones Semiconductor Index. We need this to do really well to be more positive. And then here's another look. We're coming up into the rainbow. Can we break above the rainbow with the semiconductors? We're back up here to the 200-day moving average with the SMH ETF for semiconductors. And we saw a nice little move up here with the ratio. We need this to take over and really start to go up the way we saw it at the beginning of 2024. That would really help things a lot. With tech doing well, but semis doing even better. And that's when this ratio really goes up. And the staples to tech ratio continues to fall. That's positive for the S&P. And coming down a little bit as and there's a 1 day delay here with this chart. So the shorter term correlation is working off a little bit. The longer term correlation is building up slightly. And I've been watching this. I was actually going to do another video just on this chart. It's we're concerned about what happened at the end of 2021, and then everything fell apart in 2022. And we were looking that way here, but now we seem to be looking better with this. I still might do a video just analyzing this particular chart, but this is showing some improvement when we look at the SPY to staples. And oil, it got along for the upride too. We're getting up almost to 62, and the dollar bounced up here, but it's got a ways to go to try to establish an uptrend. And here's Truflation coming up with inflation currently at 1.68. We did go up with the 10-year yield, and we came down with the 10-year based on price. We'll watch that. And we're back to being regular here with the 10-year to the 3-month. We're watching that. And we're really improved with our growth to value ratios for the Qs to S&P, discretionary to S&P, large cap growth to large cap value. Large caps, mid caps, small caps declined a little bit, but actually it's been doing pretty well lately, and they're all above advancing moving averages. And we're still declining with the staples to S&P ratio. That's more positive for the S&P. So what's our outlook then for Tuesday? Okay, I didn't change this. We're positive across the board here. And we're going to get CPI and the NFIB Small Business Optimism Index. But CPI, in my opinion, the second most important report of the month economically. And then what's going to be more fallout here with everything going on with the tariffs, and just is there more follow through, more information that will be coming out? And then Wednesday is a pretty slow day as far as economic reports, just the MBA Mortgage Applications Index. A massive day is going to be Thursday. Initial claims, we've been really watching those, retail sales and PPI on the same day. And if that's not bad enough, Fed Chair Powell is going to give a speech. And then on Friday, we have consumer sentiment, which lately has been pretty influential. And here's a look. We have Tuesdays and what they're anticipating here for CPI. And then Thursday, all this other stuff going on. My goodness. All right, then seasonality. We're actually negative for May 13th with the Dow and S&P. We're neutral to negative with the NASDAQ. And we're in options expiration week now, which it's almost a coin toss here. It tends to be down a little bit more than up for options expiration week. And here we have CPI coming out. And we were seeing during a post-election year some negative seasonality. Maybe some positive seasonality will be able to kick into gear. We'll see. And then here are the pivot points. They've already been posted on the YouTube community tab if you find them useful, and I can't see why you wouldn't. This is a very useful tool here just to show the support and resistance intraday levels for Tuesday's session. All right, now we're seeing a bit of a mixed picture here with our smart money indicators. We're positive with accumulation distribution and the Chaikin oscillator, but we're still negative with the Chaikin money flow. So I'm just keeping it on this side for right now. We're still longer term negative with our growth to value ratios for the S&P and discretionary to staples, but they are improving. And our long-term special K chart is trying to turn up, but it's still negative. Then the positive side, we are positive with the McClellan oscillators and summation indexes for the S&P and NYSE. The bullish percent indexes are positive, the parabolic SAR, the Swindlen trading oscillator, the moving average studies. It's nice to see all of them back above 50, short and long term. Momentum is positive, and the ease of movement, money flow, and ultimate oscillator are positive, as is the vortex, financial sector, and the momentum for the NASDAQ 100. Conclusion, we're here, I did change it here. We're positive in the short, intermediate, and long term now, but we're overbought in the short term. And we're becoming more overbought, but positive in the intermediate term. And for the first time in quite a while, I actually changed this back to positive because we're above the 200-day simple moving average, but we are still in a downtrend. Thank you. I hope you found this helpful. I hope you have a great day. And I won't talk to you again, at least in the daily video, until Thursday.